You know, you've seen the headlines. Every single week, it's another $100 billion, another massive mega campus, another record-breaking artificial intelligence model. Honestly, the numbers have gotten so massive, they almost stop registering, right? We just kind of scroll past them. But in this explainer, we're going to pause. We're going to pull back the curtain and look at the unseen financial machinery that's actually funding what the CEO of NVIDIA is calling the largest infrastructure build-out in human history. Because underneath it all, we're looking at a hidden mountain of debt. Okay, let's just stop and think about this number for a second. $700 billion. That is what big tech is on track to spend this year alone just building out AI capabilities. It's a completely astronomical figure. But strangely, nobody is asking the most obvious questions sitting right in front of our eyes. How on earth are these companies actually paying for all of this? Well, the core mystery of this explainer lies in a pretty staggering discrepancy. When you look across just 5 major tech companies, there's about $1.35 trillion of visible debt. That's the debt sitting right there, plain as day, on their official books. But researchers recently found a mind-boggling $1.65 trillion in obligations that literally never appear on their balance sheets. Think about that. The hidden pile of debt isn't just bigger than the visible one, it completely dwarfs it. Take Meta, for example. Their off-balance sheet debt is nearly triple the reported debt. And moving that much money completely out of sight, that isn't some magic trick. It requires a highly coordinated, complex financial system. Section 1. The AI spending spree. To really understand how we got here, we first have to wrap our heads around the mind-boggling scale of this cash outflow. To put that $700 billion spending spree into some kind of perspective, it basically equates to roughly 2.5 cents of every single dollar produced by the entire United States economy. So the crucial point to understand here is that no single source of money on Earth is deep enough to fund this alone. They had to start knocking on literally every door that might have capital behind it. Section 2. From vaults to bond markets. Naturally, you'd think these tech giants would just use their own massive cash reserves, right? I mean, on the surface, these are the safest borrowers on Earth with net debt to earnings ratios that are just incredibly low. But check out the shift happening right now. Historically, for most of the last decade, these companies reinvested about 40 to 50 cents of every dollar of cash they produced back into their businesses. But look at this year, 94 cents. The vault isn't funding the build-out anymore. The build-out is completely draining the vault. They are running their entire cash engine right now just to finance AI. So when the cash vault starts running dry, what do? They hit the bond markets, and they hit them at a pace we have literally never seen before. Just to give you an idea, from 2020 to 2024, the 5 biggest tech players issued an average of about $28 billion a year in bonds. Then in 2025, that jumped to over $100 billion. And in just the first 5 months of 2026, they issued another $159 billion. In 5 months, they borrowed more than in the entire previous 5 years combined. They essentially capped out the entire US market and had to go international. Alphabet even raised $32 billion overnight across 4 different currencies. This explosion of borrowing is getting so massive that it's triggering global alarms. Tobias Adrian, a senior official at the International Monetary Fund, pointed this out, noting the very real financial stability risk as these major tech firms leverage themselves up so heavily. Section 3. Enter the shadow banking system. Okay, so when the absolute deepest capital market on Earth can no longer absorb what you need, you're forced to look somewhere else. Welcome to the shadows. Right before the 2008 global financial crisis, a prominent economist named Paul McCulley coined a term for a secondary banking system that was growing in the dark, the shadow banking system. These are institutions that borrow and lend exactly like banks, but because they aren't technically classified as banks, they operate without deposit insurance, without a Federal Reserve safety net, and without formal banking regulations. It is basically an alphabet soup of completely unregulated vehicles. Let's break down how this actually works in plain English, using something called a special purpose vehicle, or an SPV. Say a company wants to borrow a mountain of money, but absolutely doesn't want that debt showing up on their books. So step 1, they create a legally separate SPV with its own name and its own bank account. Step 2, the SPV borrows the money. Step 3, the SPV buys the data center, or whatever the asset is. Step 4, the SPV leases that asset back to the original company. Honestly, it's exactly like taking out a credit card in your cousin's name. You swipe it, you enjoy what it buys, but when the bank asks about your debts, your answer is technically 0. Section 4. Inside the trillion-dollar loophole. Now, back in 2007, this shadow system was built entirely on piles of mortgages. Today, it's built on AI data centers. Let's dig into the public filing footnotes and look at a real-world example of this machine running live.
Enter Project Beignet. It's the largest project financing ever completed as an investment-grade bond. 27.3 billion, and it's all riding on an SPV named after a New Orleans fried pastry. This single vehicle exists for exactly one purpose: to own a massive data center campus in rural Louisiana. Meta announced it, Meta designed it, Meta builds it, and Meta is literally the only tenant it will ever have. But legally, that $27 billion in debt belongs entirely to the pastry.
So how exactly do they pull this off? Well, it all comes down to a really brilliant but honestly kind of concerning accounting loophole. The SPV, which they called Beignet Investor, has an equity split. A private investment firm called Blue Owl Capital puts up 80%, and Meta takes the remaining 20%. Because Meta's ownership sits at exactly 20%, accounting rules dictate that Meta is technically not the primary beneficiary of the venture. And since they aren't the primary beneficiary, poof, that $27.3 billion in debt legally vanishes from Meta's balance sheet entirely. But here's the catch, and it's a massive one, buried all the way on page 106 of Meta's annual report. Meta gets to sell two totally different stories. To Wall Street, they stand up and say, hey, we don't own it, and this $27 billion isn't our liability. But to get the bondholders to actually fund this whole thing, Meta whispers a very different story. They say, don't worry, we've provided residual value guarantees. Basically, if Meta walks away and this highly customized Louisiana data center is suddenly worth less than a $28 billion floor, Meta promises to write a massive check to make those bondholders whole. So there's no debt on the books, sure, but there is a massive guaranteed hook hiding right there in the fine print. Section 5. A déjà vu systemic risk. And here's the thing. Project Beignet wasn't just a one-off deal. It basically became the blueprint. BlackRock recently marketed the sequel, Project Sopapilla, for another Meta AI data center down in Texas. Same 80-20 split, just a different pastry. Let's zoom out for a second. This exact off-book debt structure has multiplied 8 times over since 2022. Big Tech has now signed legal contracts pledging nearly $1 trillion for future AI data center leases, but over $660 billion of those obligations are completely invisible on their main balance sheets. Morgan Stanley actually estimates the total off-balance sheet exposure across the entire industry right now is roughly $1.8 trillion. Which brings us to a frankly terrifying historical parallel. What we are seeing is 5 major borrowers using the exact same structure, funded by the exact same small handful of lenders. And as history tells us, when risk stops being diversified, it becomes systemic. The last 2 times a financing structure standardized this incredibly fast across an entire industry, telecom vendor financing right before the dot-com crash, and mortgage securitization right before the 2008 financial crisis. In fact, one lawyer who spent years working on the 2008 litigation described watching all this unfold with just 2 words: déjà vu. Section 6, the ultimate 4-legged bet. So, where does this actually leave us? We know the cash is gone. The bond markets are saturated, and this shadow banking debt is just ballooning. Let's look at exactly what needs to happen for this whole financial house of cards to stay standing. This is no longer just an investment. It is a 4-legged parlay where every single leg must hit perfectly. First, AI revenue has to literally multiply, not just grow. They're spending $700 billion against roughly $110 billion in estimated AI revenue. Second, the returns have to stop shrinking. The return on every new dollar invested has already slid from 40% down to 20%. Third, the borrowing window must stay completely wide open because their own cash flows leave a $1.5 trillion funding hole through 2028. And fourth, the physical U.S. power grid has to somehow absorb all this massive new energy demand without failing. Which leaves us with one final, absolutely vital question. When you look at the $1.65 trillion hiding in the footnotes and the massive, massive risks piling up in these shadow vehicles, is this all still just a bold investment into emerging technology? Or have we accidentally created a fragile, highly leveraged parlay where every single leg must hit to avoid a devastating crash? Think about that the next time you see a headline about a shiny new AI mega campus. Thank you so much for joining me for this explainer, and remember to always keep asking the hard questions about where the money is really coming from.